how much of a trade-off are we seeing between monetary policy and financial stability? Or how much of a trade-off did we see between monetary policy and financial stability at this MPC meeting? Bearing in mind that we've seen in advanced economies like the US and even Switzerland, the US especially, just earlier on, we did take Janet Yellen, who is the Treasury Secretary, that's the Finance Minister of the US, talking about failed banks.
Yeah.
So how much of a trade-off was the MPC really on in terms of monetary policy, while we're also still having one eye on financial stability? Or financial stability did not matter and you went on full on monetary policy?
I think the dilemma always has been trade-off between monetary policy,
and
objective
growth.
prices, and growth.
But this
time around,
it was
largely around, yes, you are tightening. We are aware that conditions are already tight in the banking system. We see the signals for that from the rates, the treasury rates, the OBB rates that are within the markets. We see those ones going up. Don't forget that those rates were, very, very low, sometimes less than 1%. We see that going to 9, 10%, and even above 10% now. That means liquidity conditions in the banking system is tight. This will likely affect the rate of growth or expansion of credit, which is what we need to drive growth. Now, when we saw what happened in advanced economies in terms of the bank failures, the question is now, how exposed are your banks? How resilient are the soundness indicators of your bank to these external shocks? So the assessment by monetary policy members was the fact that if you tighten further, what implication will it have for financial system stability? How will it, because if you look at what happened in the SVB, it was largely, maturity mismatch, in the sense that when some of the instruments they are holding were marked to market, losses were, declared immediately. Otherwise, they had short-term funds that came in and invested in long-term instruments. And because rates were going up in the US, at mark-to-market, those facilities were loose because you buy them where they are cheaper. Now, the yields on them so that was what really impacted on that bank very quickly. So on the Nigerian side, it was important for the members to look at what is the state of your financial system, particularly the banking institutions. How resilient are they? How robust are the parameters we look at? Capital adequacy ratio, liquidity ratio, their earnings, to be able to withstand this. So the members saw that, yes, there's a room, for some buffer condition where even if you go higher, albeit moderately, we'll be able to solve the inflation problem and still keeps the banks, going concern.